third quarter financial year 17 balance of payment data, which was released late last week. So the data was in line with expectation. However, it is on the lower side, which is balance of payment has turned into a deficit vis-a-vis the surplus that we were seeing for the last 3 quarters. Now, what has particularly happened in the third quarter is that imports have risen substantially, and that is largely being led by higher oil imports, which is as widely known because of the higher international crude oil prices. And at the same time, there was sharp rise in gold imports in case of India, and that was for 2 reasons. One was the Diwali season, and second was the impact of demonetization when a lot of currency got shifted to gold assets. So these were the 2 reasons because of which we saw a sharp rise in imports. At the same time, exports more or less remain stable vis-a-vis the last couple of quarters. In terms of net invisibles as well, while there was a marginal increase versus the previous 2 quarters, it is nothing significant. So as a result, we saw that current account deficit surged to 1.4% of GDP versus about almost negligible to about 0.3 to 0.4% current account deficit that we were seeing in the last couple of quarters. Talking from how this current account deficit was funded, again, we saw that capital flows were much lower than what we were seeing in the previous few quarters. So FDI and FIIs have been a big supporting factor for financial year 17. However, what has particularly happened in the third quarter of financial year 17 is that FII flows plunged, and again that was for 2 reasons. One was the election of the new US President Trump at that point in time, and also the demonetization hit. So because of that, we saw a contraction of about $8 billion in terms of the FII flows. At the same time, while FDI flows were strong, it was not as strong as as we saw in the earlier quarter. So for this quarter, the number was at about 9 to 10 odd billion dollars versus about 17 to 18 odd billion dollars in the previous quarter. So because of this segment, another thing to highlight is the NRI deposits, which saw an outflow, and that was again a remittance which was due in the third quarter. So combining all these factors, we saw that capital flows in the third quarter were on the lower side at about 6 to 7 billion dollars versus the double-digit number that we were seeing for the last few quarters. Now going ahead for the fourth quarter and financial year 18, we are anticipating that imports will remain around the current level. So we are not expecting that imports will rise substantially from the current levels, and at the same time we are expecting capital flows to return. Therefore, we are of the opinion that balance of payment should see a surplus level going ahead in the fourth quarter financial year 17 as well as financial year 18. This is of course assuming that oil prices remain sort of stable around the current level. All in all, we are anticipating that fourth quarter current account deficit will be much lower, somewhere around 0.6% of GDP, and that's the reason for the full year we are maintaining our estimate at 0.6% of GDP. And for financial year 18, we are expecting it to trend higher to between 1 to 1.5% depending on where the oil prices are, and largely we are expecting oil imports to rise, assuming that all in all oil prices will remain higher in financial year 18 versus financial year 17. So that's where we are expecting some bit of dent to come on current account deficit. Other than that, we are not expecting a significant jump in exports as well as net invisibles. So yeah, we feel that current account deficit should be in the range of 1 to 1.5%, which is, while higher than financial year 17, it's not a very concerning number, considering that capital flows are expected to remain strong towards India, and therefore it should be well funded. Talking from the currency point of view, we are of the opinion that currency for financial year 18, while similar to financial year 17, will remain range bound between 65 to a 69 kind of level. Currently, we have seen a significant appreciation post dollar, dollars movement. In case of India, we are not expecting significant appreciation from the current levels. At the same time, a significant appreciation cannot be expected at the current juncture when dollar has changed its trend, and at the same time capital flows have improved towards India. So for the financial year 18, we are maintaining a dollar rupee average at 67.5 and a range of 65 to 69. Yeah, that's about it. Thank you.